Mortgage rates have been quite unfavorable over the past few years. Luckily, after peaking at nearly 8% in October of 2023, we started to see rates cool down, albeit very slowly. So where are rates headed in 2024? We'll stick around as we go over the current state of the market and whether or not mortgage rates will improve this year. So where are mortgage rates right now? Over the past year or so, mortgage rates have risen to their highest levels in decades, making it challenging for investors and home buyers to secure homes at a favorable price. In early February, the average mortgage rate on a 30-year fixed mortgage is around 7.2%. It's hard to say what mortgage rates in 2024 will look like going forward. However, most real estate experts remain hopeful for lower rates throughout the year. Here's what a few of them have to say. Chief Economist Lawrence Yun from the National Association of Realtors predicts that mortgage rates are headed towards 7% in a few months and into the 6% range by the spring of 2024. The Fannie Mae housing forecast predicts that the average 30-year fixed rate will hang around 7% for the first quarter of 2024 and fall to 6.5% by the end of the year. In MBA's mortgage finance forecast, they predict that mortgage rates will decrease from 7% in the first quarter of 2024 to 6.1% by the fourth quarter. In a 2024 housing market forecast, experts at Realtor.com expect rates to average around 6.8% this year, dipping to 6.5% by the end of the year. In the latest U.S. economic forecast, the economics group at Wells Fargo predicts that the 30-year conventional mortgage rate will drop to 6.85% in the first quarter of 2024 and decline to 6% by the end of the year. Interested in learning more about what's important to investors, property managers, and tenants? Well, hey there, it's Alyssa from Bay Property Management Group. Just a quick pause in the video as a reminder to hit that subscribe button so you never miss out on the latest videos with new content uploaded weekly. We appreciate your support, and now back to the video. Several things can affect mortgage rates in 2024 aside from personal factors. So here's what to keep in mind while looking at mortgage rates. Inflation. Inflation is when prices for things go up over time, making each dollar buy less. For mortgage lenders, this means they have to charge interest rates to cover the loan and make up for potential loss in purchasing power due to inflation. If mortgage rates are, for example, 6% and inflation is 2%, lenders are essentially making a real profit of 4%. So lenders watch inflation closely and might adjust rates to ensure they earn enough to keep up with rising prices. Rate of economic growth. When the economy is doing well, with more jobs and higher wages, people tend to buy more homes. This increased demand for home loans increases mortgage rates because there's a lot of competition for available money from lenders. Federal Reserve monetary policy. The Federal Reserve acts as the financial guardian of the United States, aiming to maintain economic stability by ensuring sufficient jobs and stable prices. Through their monetary policy, the Fed sets interest rates and controls the money supply. While it doesn't directly determine mortgage interest rates, its decisions impact the overall interest rate environment. So increasing the money supply generally makes borrowing, including mortgages, cheaper. Conversely, tightening the money supply can result in more expensive borrowing and higher mortgage rates. The bond market. Mortgage rates are linked to the bond market, specifically mortgage bonds or mortgage-backed securities. Banks and investment firms sell mortgage-backed securities, which are bundles of mortgages sold in the bond market. When demand for these bonds is high, mortgage rates go down, and when demand is low, rates go up. A common benchmark for mortgage rates is the yield on a 10-year Treasury bond. And housing market conditions. The supply and demand dynamics in the housing market can have an impact on mortgage rates. In a strong housing market with high demand for homes, lenders may be more inclined to raise interest rates. On the other hand, in a lower demand housing market, lenders might offer more competitive rates to attract borrowers. For expert insights on a variety of rental industry topics, check back in for weekly video uploads, and don't forget to hit the notification bell for exclusive updates. Thanks for watching, commenting, and subscribing. We will see you in the next video.